Thank you for joining this month's Grains Fundamentals Update with Kpler. My name is Matt Dara, Grains and Oilseed Analyst at Kpler, and I'm joined today by Ishan Banu. If you're unfamiliar with how these webinars are typically structured, we usually go through the crop fundamentals, looking at sort of the key market drivers, both short and longer term. And then we also will be looking at sort of trading strategies. So after we factor in these kind of fundamentals and these market dynamics, how can you go about sort of trading off the back of this information? So we're happy to take any questions throughout the webinar. We'll usually take sort of brief breaks in between sections where we can take some questions. But we'll also have a Q&A section at the end of the PowerPoint of the webinar where we can take some more questions too. So please feel free to ask any questions that come to mind in the chat box, and we'll do our best to get to them. But without further ado, happy to pass over to yourself, Ishan, to begin the webinar.
Thank you, Matt. Welcome, everyone. So let's get into it. With the government shutdown, there are key metrics that are weekly and monthly released by the USDA and other agencies which traders don't have access to. So a few algorithmic inputs that the trade uses is basically, and it depends on the season, but right now in the October VAS day, people were looking for updates on the corn and soybean yields. They would look at key global numbers such as production, world production and ending stocks, and US ending stocks as well. Also looking for big changes in world import demand, especially with China. Weekly sales is another volume driver for the markets, which is being missed, but inspections are still being released. So that is at least a good weekly data point to trade. If this goes on for longer, then there are other major reports which the market will miss, mainly the quarterly stocks, which will give the 1st of December stocks for grains in the US. The quarterly stocks report is an important report because it gives the market an understanding of US feed usage. Feed and residual is usually a calculated number based on stocks. So in absence of that, the demand side in the US would be unknown to a certain extent, and there the market would be flying blind. If it continues further, then there could be serious data gaps, such as no ag forum in February, and further we'll have the prospective plantings and acreage reports impacted. But if it goes that long, it will be by far the longest shutdown on record. So the impact of this has been seen, especially in volumes and sort of sideways shift of the market. If you look at the blue bars on the right, this is CBOT volumes for December corn futures. The lighter blue bars are the VAS day dates, and especially in August with the change in yields in September as well, you saw big volumes traded. The last major report from the USDA was on the 30th of September with the grain stocks. That also brought a lot of volume to the market. We didn't see that surge, obviously, through the VAS day report day in October, where volumes weren't outstanding. So in absence of volatile data points every week and every month, the trade is shifting to look at overall annual balance sheets and US ending stocks. So the key traded metric right now remains US ending stocks for 2025-26, which is August ending stocks for soybeans and corn. So at Kpler, our methodology bears a lot on building robust global S&Ds. So we spend a lot of time analyzing import demand and consumption demand across the world. So we trade yields and production, and we publish yields and production like everyone else, but we also spend a lot of time on global trade and import demand. So Kpler data allows you to follow real-time flows, real-time and nearby forward flows. The insight section helps you forecast global monthly import demand, looking at price and seasonality. So, for example, our views on US exports and, for example, Chinese corn demand have been consistently closer to closer to reality and were proven um, correct uh, throughout the last 2 years since we started publishing this. And just as a data point, for 2024-25, uh, our USDA ending stocks were closer to actual, more close to the actual number than the WASDE report, 15 out of 16 times. So we'll do some of this in today's webinar, where we look at global demand, export outlook, competition, and the resulting effect on the balance sheets. Before moving forward, I just wanted to say, in absence of regular data points, that the other green peak in volume that you see is basically tweet-led. So continual tweets out of the White House are affecting the market and do lead to certain volume surges once in a while. So with that, let's look at row crop balances. We'll start with corn. The market expected a reduction in corn yields in the WASDE report this month. Our corn yield is at 185.7, slightly lower than the September WASDE of 186.7. This is based on weather, vegetation health, and geospatial analysis. So, and our production reflects this we use last published USDA acreage, and with 185 yields, our production is slightly lower than the USDA. However, when we look at exports, our export, we recognize that export sales have been strong, but the outlook for annual US exports isn't that great, especially when compared to last year. So we expect US exports to be very high this year, but not as high as the USDA had in its September report, and not as high as last year. And the reason is basically this seasonality. US exports last year, in the months of March, April, May, and June, really peaked because US exporters had a lot of pricing power, and as we'll see in the next slide, very little competition through those months. So that really allowed US exports last year to be over 70 million tons. This year, so if we look at the chart on the left, this is export seasonality out of major exporters. If we look at the US export peak earlier this year, this is the time when Brazil is busy exporting soybeans, so it's not really in the market at that time. Argentina and US are the only two major exporters. Most of Ukraine exports were to Europe at that time, and overall Ukraine also had lower exportable surplus last year. So in essence, through Q2 of this year, US only competed with Argentina for corn exports, and Argentina could not compete with on volume with the US. So US corn exports are high when prices are high and when they have more pricing power. So contrary to other countries where low prices increase exports, in the US it's the opposite. So we expect very strong US exports this year as well, but we don't foresee months or periods where US will have that sort of slightly monopolistic power on corn exports. Every other exporter also has more has produced more year on year. Brazil, Argentina, Ukraine, and Russia, all of them. So increased competition for US corn will reduce exports year on year. This is obviously the result of our analysis, but behind this, we have looked at it country by country, month by month, and the chart on the right gives an idea of where exactly the difference is coming from. So the main difference comes from Japan and Korea, or Asia in general, where um, price-sensitive buyers will buy South American corn for longer next year than they did earlier this year, uh, for the reasons mentioned before. China is not very visible because it goes from low to lower, but overall, uh, exports will be lower than last year, despite a significant increase in exportable surplus in production. What does it do to the balance sheet? If we look at the chart on the left, USDA has ending stocks of 2.1 billion bushels, around 54 million tons. Our ending stocks are at 63 million tons, 2.4 over 2.4 billion bushels. This is mainly because our exports are much lower than the than the USDA, and uh, and this includes the lower yields for the 2025 crop. Another way to look at the whole thing is the chart on the right. Now we split the balance sheets monthly and looked at August ending stocks at August stocks at all countries, just to compare it to the US and to previous years. So the reason why in 24-25 US exports were so high was this bar over here. Uh, August stocks at Brazil, Argentina, Ukraine, and Russia combined, and Brazil alone were the lowest in 3 years at this point in August 2024. This was mainly because of a poor safrinha crop in 2024, and lower than ideal, lower than trend yields in all major exporting countries. In August 25, this is an established fact. This is not a projection. In August 25, um, ex stocks at other exporters were the highest on record. So this means there'll be much more competition. Each one of the other countries will compete for exports, and while the US does have a record crop, it will not have record exports. So and going into next year as well, we expect other countries' stocks to be high. So that's the idea on corn, basically, where we expect ending stocks to be over 2.4 billion bushels, with slightly lower yields than the USDA had in its last report. We'll move to soybeans and take questions after the soybean section, maybe. Let's look at the same chart on soybeans. On soybeans, our similar analysis similar geospatial analysis uh, brings our yields to 54.5 bushels per acre, slightly higher, which leads to slightly higher production than the USDA has in its balance sheet. Now, um, in soybeans, of course, China is the elephant in the room, but we've been talking. So our regular attendees would know we've been talking about this for a while. Um, the As Brazilian exports to China reduce, there is a question of whether China will be able to um, go through a low import period for a couple of months before the new crop from Brazil is available. So one of the out of several data points, one of the proxies we can use is the soybean meal inventory in China at major Chinese crushing plants. And soybean meal inventories, if you see last year, 2024, the meal inventories peaked just before the new crop in the US. And this was in anticipation of troubles importing US soybean. Um, Brazil had a lower crop last year, and China did need US soybeans at that time. This year as well, soybean meal inventories are higher. It reflects both higher crushing despite plateauing demand and also a preparation for slow months ahead. So, but the inventories are lower than last year, which also reflects the fact that uh, there is that the dependence on the US is much lower, and they're not really that worried as they were last year about US soybeans not being able to make it to China. So if we look at major exports, our projection for high Brazilian exports and a fat tail of Brazilian exports later in this year has been proven right. We are seeing on the Kpler platform as well as in lineups that Brazilian exports continue to stay strong, seasonally lower, but much higher than previous years. US exports um, will be sharply below last year, but they will remain elevated for the rest of the year as the US shifts from supplying China through a seasonal peak in Q4. So traditionally, the US would export 80% of its exports between September and February. We don't expect that to happen this year. The Chinese peak will be absent, but the US will also have a fatter tail as every other importer imports more from the US. And that brings us to the chart on the right, where we had projected much higher US exports to every other importing country. And we are seeing that happen in Kpler data as well. Um, Earlier today, our data team highlighted how Pakistan is importing more US soybeans. So we're seeing that happen. The point to note here is that every other major importer will take more US soybeans, but that doesn't solve the equation for the US because overall total exports will be the lowest since the disaster years of 2012. And we expect ending stocks to surge to second highest levels, just below the previous trade war, where ending stocks were over 900 million bushels. Our number this year for August 26 is close to 600 million bushels of soybean stocks. And this includes the slightly higher yield that we had shown before. Weekly inspections are reflecting the same thing. They so the last inspection data point was close to 1.5 million tons, which is in line with the seasonal peak, but not as high as last year, and we don't expect it to go as high as last year in absence of Chinese demand. So that's it on the basic S&Ds for corn and soybeans. I'd be happy to take any questions at this point.
Thank you, Rishan. I think we've got one that's come through here. It's how does the heavy rainfall in China impact the corn and soybean harvest, as well as the winter wheat planting campaign?
Okay, I think so. Yes, so we were concerned about this as well, and we looked into it along with our data providers. I think I have a slide on that. Yes. So the red section over here in central China, that's where the excessive rainfall has happened. which includes about 22% of corn planted area and 15% of soybean area. So there are a couple of mitigating factors here. In similar years where high rainfall was observed during the same time, the loss in yield was 1 to 2%. Secondly, northeastern provinces, these three provinces in the northeast have had exceptional weather. So increased yields from those areas will reduce the impact a little bit. And thirdly, it's become more of a quality question because we are at harvest. So the crop was made. It is about how it is handled and dried, which will affect the quality. So that part is tough, and the Chinese government is taking measures to make sure that the harvests are dried and giving support to farmers to be able to do that. But we do expect some losses due to moisture and quality, if not on the field, in storage. At this point, we have not changed our Chinese imports because of that.
Thank you. I don't think we've had any further questions yet, but I have to proceed to the next section if you want.
Okay, great. So the next section, in fact, it will be Matt talking to you about 2026 supply. Over to you, Matt.
Thank you. So to begin with, we're going to look at what's happening in Brazil. So as we can see, chart on the left there is showing you Brazilian soybean area in production. We've got the time series starting from the 2010-11 marketing year. And one key thing to look at initially is the area. So over that time series, we've consistently seen area expansion in Brazil off the back of relatively profitable margins or encouraging margins. And as we can see, it's no different from 24 to 25. One thing to note, though, perhaps, is the rate of expansion from on year to year. So this year we're forecasting around a 2% area expansion, which is similar to some private analysts in the industry, although some are a little bit more bullish and a little bit sort of closer to sort of 5-7%. Relative to that, we're a little bit more conservative. And that's off the back of just globally quite depressed soybean prices. So while the Brazilian soybean grower is able to benefit from that sort of currency conversion between the weaker real to the US dollar, they're not necessarily immune to globally weak soybean prices. So they're getting hit by a lower return on the crop they're growing, and also they're getting pushed on their cost of production. So inputs such as fertilizers are a little bit more expensive, and also labor cost is rising in Brazil too. So from cost of production, it's not as healthy as it once was when we looked at sort of the planting and expansion from 23-24. So that's why we're seeing a little bit of a smaller or not quite as larger area expansion year on year. And as we can see, that area expansion doesn't necessarily suggest that production will increase either. We can see quite clearly in 21-22, that's a year where we had that drought condition following the La Nina weather event. And so ultimately, yes, we are expecting to see area expansion, but that doesn't necessarily indicate that we're going to see another record crop. Of course, in the market, there's lots of talk of the 26 crop being the next largest Brazilian soybean crop, but the crop is only about a fifth planted. It's the pace of it's relatively good. I mean, relative to last year, it's ahead. But relative to the 5-year average previously, it is a little bit behind. So, there's still a lot of unknowns with regards to how yield can shape up as that crop's being planted. But at the forefront currently with the information we have, it's a good outlook as things stand so far. And talking about sort of soybean planting pace naturally kind of falls into how the Brazilian corn crop's looking. So for the first corn crop, that's about a third planting pace of that's about a third complete at the moment. But of course, that kind of supply kind of gets absorbed by the domestic demand within Brazil. So when we're looking at the export impact, we're looking more closely at what the second corn crop production is like. And that obviously will benefit from the larger acreage expansion of the soybean crop. Typically speaking, when you plant your soybean crop in Brazil, the land that you use for that area is then used for the second corn crop. So if we see that soybean area increase, then we'll expect to see that second corn crop area increase too. But also what comes with that is if you're seeing delays to the planting of the soybean crop, then that can have a knock-on effect and delay planting of the corn crop. And that can sometimes discourage some corn growers in Brazil from planting corn, because then it can lead that crop into a little bit of a vulnerable position to colder temperatures when that crop, when that second corn crop nears more yield determining stages as it nears sort of wintertime in Brazil there. So while we're looking, yes, more closely at the soybean planting pace at the moment, in the back of our minds, we're also looking quite closely as what that might mean for production of the second corn crop and what that could mean for yields. But as it stands currently, that acreage expansion is favouring corn production in Brazil, and we're expecting to see generally good or in line average to production for 25-26 for Brazilian corn production. But happy to move on to the next slide if possible. And we touched upon La Nina on the previous slide. So following sort of NOAA's announcement that La Nina is present, the conditions are present now. We've got a weak La Nina weather event at the moment, and current forecast is for that to last until December 2025 or at most February 2026. And then after that, it will transition into an ENSO neutral position. But under that La Nina conditions, the scatter plot on the left there shows a relationship between that La Nina weather event and the yield, the impact it has on corn yield in Argentina. So along the x-axis there, we've got the Oceanic Nino Index. So for a weak La Nina, we'd be expecting to see anywhere between sort of negative 0.5 decimal points to negative 0.9. So as you can see, we've got a big cluster of years where that's occurred. But the chart on the bottom right also hopefully shows that the impact this has on yield is quite variable. So while we may have these conditions present, it's still a little bit uncertain to the extent of damage or impact this will have on yield. For example, in 22-23, sorry, we did see that notable impact on yield off the back of what was relatively speaking what was objectively speaking a weak La Nina event. Whereas in the sort of 2020-21, where we had a moderate La Nina event, the yield impact wasn't quite as extreme. So it's not, you can't categorically say that because there's a La Nina it'd be a weaker yield. It's something that is a little bit that can vary quite a lot. And we're looking at corn here. We had also run the same analysis for soybeans, but it yielded a lower R-squared value. So meaning that the relationship between yield and the La Nina and a weak La Nina event or a La Nina event typically has a less stronger relationship between the two. So that's why we're kind of demonstrating corn on this slide here. And just to sort of, and the map there on the top right showing what a weak La Nina means for Argentina is typically dry conditions. So at the bottom there on the x-axis, sorry, jumping around a little bit, but that's OND, that stands for October, November, December. So if we see that La Nina conditions during that period, and then if we look at the map, we've got dry conditions, that will coincide with when that corn crop and that soybean crop is developing. The corn crop is being planted as we speak, and the soybean crop will be planted in the next week or so. So typically speaking, that might be, there's obviously numerous reasons involved here, but one reason is because obviously that corn crop's planted a little bit earlier than the soybean crop. If it faces those dry conditions later on during its development, where it's a little bit more prone to an impact on yield and the penalties associated with that. So that's where we can kind of that's the impact of how La Nina can be. It's quite variable, so it's definitely a watch point at the moment. But currently speaking, we are seeing very good conditions for corn planting as it stands, and as well as plans for a larger corn acreage as well off the back of generally good agronomic conditions. So it's definitely a watch point at the moment. And then, no, thank you. Moving on to the 2026 US spring planting course. For some US growers, this will be at the back of their minds, but if we look at where the current ratio is, I think earlier today, I think it was about 2.35. So anywhere sort of around 2.3, we're leaning towards more corn planting, and then anywhere around 2.5, we're favouring more soybean planting. So based off of that current ratio, we see more acres going into corn than soybeans. Which pushes corn acreage around that sort of 90-year high that we saw last year. and it pushes soybeans just that little bit lower, around the 80 million bushel, million acre mark as well. So off the back of that larger corn acreage, obviously yield is a little bit unknown at the moment, so it's difficult to see where production will land with that. But of course, even if we're using sort of a trend line yield, this typically will bring in a greater supply of corn into the 26-27 marketing year, which the chart on the right is hopefully demonstrating where that means ending stocks could lie for not this marketing year, but the one that's due to follow. So, of course, with the very challenging export market that Ishan had explained earlier in the presentation, that means that the US is going to be carrying over quite a heavy amount of corn stocks into the 26-27 marketing year. So despite us being a little bit more bullish on the export campaign during 26-27, that still means we're seeing quite heavy ending stocks in 26-27. Whereas in contrast for the soybean crop, where we've got that tightening in the area at the moment based on the current soy corn ratio, due to that lower production, we would expect to see a little bit of a contraction in the production, and therefore seeing the ending stocks fall lower. But just to add a little bit of context, the 2.35 soy corn ratio doesn't necessarily mean that corn is a more attractive crop to grow. In current market dynamics, it's just less unprofitable. So the US National Corn Growers published a report recently which showed that this will be the third consecutive year of negative margins for US corn growers. So it's not a case that corn is an attractive crop to grow from a profitability standpoint. The market for corn is just a little bit more, or it's a little bit less bearish than soybeans at the moment. And that's why we're seeing that kind of, that's why under current circumstances, we would expect corn acreage to increase in 2026 and soybean area to decrease. But yeah, that summarizes that sort of 2026 planting. I'm happy to take any questions off the back of that. Thank you.
Thank you, Matt. There is a question to the forecast. So do the mentioned forecasts use do the mentioned forecasted Argentine crop yields affected by the real impact of La Nina? Does this similarly, so I think you've answered that. Does this similarly affect the wheat crop too?
So it has a less of an impact on the wheat crop at the moment because of the window when the wheat crop is sort of planted and harvested. So the wheat crop typically is planted earlier in the year. So we're currently looking. So the wheat crop is to be planted around I think 3 to 4 months ago, and it's now kind of the harvest has actually just begun, and we would expect harvest to be wrapped up within the next 1 to 2 months. So it will miss that dry, the threat of dry weather. Of course, sort of further to the sort of central and northern regions, we would be expecting to see maybe a little bit more pressure. Of course, harvest has only just begun in the northern regions. It's going to slowly progress to the south, where we do see a lot more production, a lot more of the national production produced in those two regions. But it's unlikely to see the La Nina weather event impact wheat production. And also, just to add a little bit of context there, one impact of the La Nina is not necessarily within 1 week or within 1 month of a La Nina weather event. It's almost like a compounding effect. So the compounding effect of dry weather for 3 consecutive months, it's far more impactful than 1 month. So if anything, dry conditions right now, which would be induced by La Nina, might actually help Argentine growers harvest their wheat crop that little bit sooner, and help them get that marketed or in the sheds a little bit earlier. So we don't see that impacting Argentine wheat production currently.
Thank you, Matt. I think that's all the questions. I just to add to that, if La Nina conditions continue, they will bring more rainfall in Australia, which is going to be good for wheat planting in Australia, although it's still 7-8 months ahead of us. But if they continue, then it'll be good for wheat in the southern hemisphere. So that brings us to wheat. We'll quickly look at what's eating the wheat market right now. In 24-25, wheat trade. So after a couple of years of post-COVID demand, wheat trade in 2024-25 dropped very sharply by about at least 15, 16 million tons. That's 10%. So global demand, import demand for wheat dropped significantly in 24-25, which to an extent also coincided with lower supply. So Europe had a much lower exportable surplus in 24-25 because of a crop failure, and and this lower demand kind of helped balance the balance sheet in 24-25. This year, our expectation, our initial projection for demand is significantly higher, about 10 million tons year on year, not going back to previous year's levels, but still significantly higher than last year. And um, we expect most of this increase to come from the southern hemisphere exports from Argentina and Australia. Yes, Europe, Russia, so Western Europe, Romania, Bulgaria, Russia, Ukraine will have increased exports, but the big pull will be from the southern hemisphere, where both Argentina and Australia are heading towards good crops. So on the supply side, we we have significantly better crops um, compared to last year for wheat, but it's the demand side that remains weak. So if we look at the chart on the right, we concluded September and we looked at July to September import demand. Year on year, it's only 600,000 tons more, and we don't see the major consumption centers, um, so North Africa, Middle East, and even Asia as a whole. We don't see a clear increase anywhere. But Turkey is a good mention. Turkish imports have increased, which is expected after a ban year. But overall, um, we we don't see the market headed towards this increase that we have projected. Uh, Now, the first 3 months may not be very representative because the peak of Black Sea exports this year has come later because of harvest issues and the catchment, the port catchment region in southern Russia having a lower crop and harvest delays. So it is possible that Q4 and Q1 exports are higher and make up for the gap. But as things look right now, we would be we'd be looking to reduce our import estimates from the current number, which is a significant increase in last year. So um, before we move on to the next slide, basically in a year without any production issues, the market is prepared to take care of 180 million tons of wheat demand. Um, it's um, except for probably the US. There's no other country where wheat area is reducing or the production is reducing. So we so with lower than 180 million tons of demand and possibly lower from our current estimate, um, we are producing more wheat than we are consuming. And that is reflected in prices. We'll look at the wheat corn spread at a later slide, but we see that in cash prices and we see that in ending stocks. So cash prices have a bunch of major exporters competing to be L1 and following some of their seasonality, as you can see in Argentina. We expect South American wheat to compete for more demand in the next few months. And Western Europe has always also been shy from the markets of France, Germany, and Baltic countries as well. Baltic countries not so much, but France and Germany have not um, have seen slow exports, slow start to exports in the year, and they normally in years like this they would normally kick in when Russia and Ukraine are done with the harvest peak and the supply pressure. So they are sort of waiting on the sidelines to come into the market when prices are better. There is abundant supply and the cash markets reflect that. And we see that in ending stocks as well, where last year we saw ending stocks drop mainly because of lower production. Lower demand also helped it not reduce too much. This year we expect ending stocks to increase significantly, um, especially given that the import demand remains weak. All right. Before we go through the outlook, are there any questions?
Yeah, we've had some that come through. One question is, what has caused or is causing the softer import demand for wheat?
So there are two major reasons, China and Turkey. Chinese imports of wheat have slowed down. So in a typical year, if you look at the last 10 years, China needs wheat imports to the tune of 3 to 5 million tons, which is basically high quality, high protein wheat for certain applications and blending. Um, for example, if you have to make a really thin sheet of flour to cover your dumplings, for that you need higher protein wheat. So um, China has so the 3 to 5 million ton is the base case, but in the last couple of years, post COVID, China had imported much more wheat, uh, um, mainly because the prices supported it. It was opportunistic buying, and um, in 24-25, that didn't happen. Chinese imports of wheat went down to their basic requirements. So from above 10 million tons to I think 4 to 5 million tons in 24-25. The other one was Turkey, where imports were banned because of a good domestic crop in 24-25. We don't see China importing much wheat this year either, but we do have Turkey importing wheat in the balance sheet.
Thank you. We have got another question on soybeans, and it's regarding sort of, well, what's your view on Trump tweets about soybeans? Do we think a deal is likely to be agreed upon with China next week? And do we think, if there'd be a volume of trade if a deal was agreed upon? Thank you.
Okay, I will answer that question in 2 slides time. Uh, there is some material over there. Okay, so in our outlook, we're looking at certain key spreads which we have been following for a while, and we talk about it with our regular viewers. The wheat corn spread on the left is at a historic low or at a recent history low for this time of the year. At I think below 80 cents, the wheat corn spread ideally in the market should send a message that it's cheaper to feed wheat in most destinations. Uh, and that usually brings the feedback to the market and drives wheat prices up relative to corn. We don't see that feedback in the cash market right now. So despite very low wheat corn spread levels, it seems that at low prices, um, the switch from corn feeding to wheat feeding isn't happening because both prices are low. This switch happens a lot when both prices are high. So when in the past 10 years, when you've seen corn above $6, that's when there's a lot of sensitivity to price and switching of feed. So the point here is that despite low wheat corn levels, we're not seeing any significant increase in wheat demand versus corn anywhere in the world, except in Europe to a certain extent. So the feedback from the cash market is missing, and that feedback is what would push the spread up. So um, there is no strong impetus for this spread to rise. It might flutter around a bit based on volatility, but people would independently look at the wheat and corn S&Ds, and this spread would likely be a result of that rather than a change in demand because of the spread itself. We've also looked at calendar spreads. So if we look at soybean calendar spreads, um, the next three spreads basically have been flat over the last couple of months, and every time there was a peak, it was usually around a tweet and expectations of a trade deal with China or talks with China, and we see something similar happen this week as well. So um, the the balance sheet and fundamentals should make you bearish this spread, and it should towards move further towards full carry um, if you just go on fundamentals. But in the near term, that could be a risky bet because of trade talks. So let's look at what the market will look at in the next couple of months. Um, as we have seen intermittently happen, right now people are looking towards a trade deal with China. It has kept the market optimistic. It has rallied spreads a little bit in both wheat and corn. You saw in the first slide how it has brought a lot of volume to the seaboard corn market. Um, it's our opinion that the market is unlikely to find closure. There have been several such attempts, and even if there is a deal, the details will not be clear. And even if the details is clear, further trade action will be very skeptical. As a Chinese importer, I would not want to be the first one to buy a cargo of soybeans from the US. So we expect current volatility to continue, maybe reduce a bit after next week, but maybe come back again in a month's time. We are not going to find closure to this issue. The effect of a possible deal, um, in our opinion, will be more felt in corn than in soybeans. So if it's a deal just to buy it's unlikely to be a deal just to buy soybeans. If it is to buy soybeans, then if we look at China's coverage, uh, the window for importing from the US is very small. If we get a deal in the beginning of November, you could buy second half December or January shipments out of the US. After that, February onwards, Brazil will have its new crop available, which will compete on price. So it will just be like um, any typical year without a trade war, where Brazil and the US will compete uh, on price, and Brazil, with its new crop of 170 million tons, will be better placed to win that competition. Um, it will actually be bearish Brazilian prices, because Brazil will have to compete in a fair market, in a free market, rather than have a premium because the US doesn't make it there. But if it's a deal to increase trade, and let's say China agrees to buy more US agricultural products, then we could see a significant increase in Chinese corn buying. Um, from a balance sheet perspective, China doesn't really need uh, a lot of corn this year, but China is always happy to buy and store. So prices are very low. Ending stocks are above 2 billion bushels. In our case, 2.4 billion bushels. That's in the past 15 years. China has done this twice, where when ending stocks were very high and prices were very low, China bought opportunistically and stored the grain. So Um, Again, this is if a deal happens, it'll be good for corn, and the heavy ending stocks that we see can be reduced significantly because of Chinese demand. Aside from this and tweets, um, the market is now moving from trading US key yield numbers and production numbers to the balance sheet and to ending stocks. The Over time, the market is realizing the competition that there is in the corn market as well, and people are looking towards US ending stocks. So, so availability of grain from South America will affect US ending stocks for next year, and that is what will be watched over the next 2 months. Brazil and Argentina are planting their first crops, uh, both soybeans and corn, and La Nina is a possible threat, and especially to Argentine corn. And over time, if we see normal weather prevail, we should see risk premiums fade, and the realization of a very heavy US ending stocks be absorbed into the market. In wheat, supply pressure will continue. Western Europe hasn't really started exports in earnest. It is still Exports are still similar to last year levels where production was much lower. So they are looking for a window where they can compete, um, and not really finding it because of the longer protracted harvest and export pressure out of the Black Sea. And yeah, just as a note, again, we have seen a very similar year recently in 2020, where we had very high ending stocks projected. We had also seen it in 2018, where we had over 2 billion bushels of corn um, ending stocks in the projection at the beginning of the year. In several instances, when this has happened, the surprise came from demand. So yes, there were several years where there were production upsets in certain countries, and that completely changes the picture. But aside from production upsets, the surprise demand came from China, and this year and in those years, China was on the sidelines. It was not a subject of a major trade war or or any such issue. So this year, it's if it wasn't for politics and the trade war, China would have bought a lot of corn and would have bought the normal amount of soybeans from the US. But that surprise is less likely this year unless there is a deal. A couple of charts here. The soybean corn ratio, if we look at, so this chart shows the soybean corn ratio for November and December, which is the harvest ratio for US soybeans and corn. So at this time last year, so the chart in lighter blue is the 2025 spread in 2024, and the darker blue is 2026 spread right now. So at this time last year, the soy corn ratio was slightly lower than 2.35 where we are at now, and it went further lower to really increase corn acreage and reduce soybean acreage in the prospective planting report over here. At 2.35, like Matt mentioned, we should see a small increase in corn acres and small reduction in soybean acres. But if the ratio goes, and again, the direction of this ratio depends on the trade deal, but if there is no deal, it is likely to go lower and further exacerbate the corn supply and ending stocks in the US. And as the risk premiums for South American production fade slowly, we should also see corn spreads tend towards full carry. In the last couple of weeks, the spread has strengthened a bit, because of the tweet trouble. But again, fundamentally, the spreads have no business trading 44% of full carry. And if you look at what happened to the SEP deck, it ended up at 80% of full carry, and we expect front month spreads to do that as fundamentals take hold. Corn is still being harvested in the US, and exports, especially from the last export sales, exports are strong initially, but it will need to be carried. So a record crop has to be stored, and we should see spreads support that. That brings us to the end of our outlook, and again, happy to take questions.
Thank you, Rishan. We have had another question come through, and it was, what's the scenario if Ukrainian wheat falls back to 2022 levels? I think that might be in regard to exports, perhaps.
Yeah, 2022 Ukraine. So not much, in my opinion. I mean, yes, of course, if you're trading Black Sea wheat on the cash markets, it'll be reorganization of who supplies to whom. But if you look at the supply coming from Argentina and Australia this year, overall, we are building significant stocks in the wheat market. So, for the overall balance and for futures, an upset in Ukraine is not going to cause a major issue.
Thank you. And then just one other one that's come through. What is your forecast for Brazilian corn ethanol production expansion, and how do you see that impacting the export market?
That's a good question. So it brings me to mention that in all of our balance sheets and ending stocks projections, we have taken very detailed a very detailed look at domestic demand as well. So for the US soybeans ending stocks and projections, we have considered the biofuel policy, and we have penciled in a significant increase in soybean crush in the next 2 years. Similarly, we have around 23-24% increase in Brazilian corn ethanol production next year, and another 20% increase in 2027. And that's in the balance sheet. So the high exportable surplus that we get is in spite of significantly increased domestic demand.
Thank you. I don't think we've had any further questions that have come through.
Great. We are always happy to talk to you and take questions and talk offline, not just through the webinars. So if you have any questions or you want to discuss markets, please reach out to us at this email address. Thank you for joining.